Hello students, welcome to Accounting 2401, Principles of Financial Accounting. This is Dr. Mercado speaking, and in this lecture we are going to begin covering Chapter 2, which deals with analyzing transactions. Now this particular lecture we are going to be covering how to complete exercise 2.7a, which basically deals with journalizing transactions in a general journal. Okay, I do want to remind all students to please make sure that you have read the entire chapter before you attempt any of your assignments. Please make sure that you have a printed copy of your syllabus and that you mark off all of the items for the week as you complete them. That way you don't fall behind or you don't miss anything. Please organize your time. That way you make sure that you are able to complete all of your weekly tasks on time. Okay. Now, before I go over the problem, I just wanted to go over some quick information from the chapter. Okay, this particular problem deals with the double entry accounting system. Okay, what it basically, the double entry accounting system requires is that every business transaction that is recorded affects at least two accounts. Okay, the total debits recorded for each transaction needs to be equal to the total credits. Accounting is a balancing act. Debits must equal credits at all times. Okay. It is very important. I don't ask students to memorize a lot of information, okay? But if there's one thing that you do need to know by heart are the rules of debit and credit and the normal balances of the accounts, okay? At the beginning when I started my accounting journey, I always had this with me. This is kind of like a map of what you need to do when you're working on transactions, okay? So, do you need to debit an account? Do you need to credit an account? Is it increasing? Is it decreasing? You're going to be using this a lot, okay? So, the rules of debits and credits. Every account has a normal balance. What does the normal balance means? It basically means that for that account, you expect that account to have a balance, and the ones in green are the normal balances of each account, okay? So, at the end, when you're balancing each of your accounts, because each account gets balanced separately, the balance needs to be on the normal balance of the account, okay? So, for example, assets. Assets are anything that you own, okay? The normal balance of an asset should always be a debit, okay? A debit increases an account, okay? So, you should, how can I say this? You can have a negative amount, like for example, cash. If you overdraw your account, you're going to be negative. Should your account be negative? No. You should always have money in the bank, okay? Can you have negative supplies? Well, no, you cannot. Okay, supplies are an asset. So, when you use up supplies, you credit the account, but the balance of supplies should never be a credit balance because that means you have negative supplies, which is impossible, okay? You can't use up something you don't have. So, every time you have an asset account, the ending balance on the account should be a debit. Remember, the ones in green are the normal balances of each account. So, cash should have a debit balance when you balance it. Supplies should have a debit balance. Office supplies, equipment, automobiles, anything that you own, land, everything should have at the end a debit balance. There are transactions, like I stated, that will require you to credit these accounts. Let's say, for example, cash should have a debit balance. But let's say, for example, you pay your rent. How do you pay your rent? With cash. So what happens when you use up your cash to pay your rent? Well, your cash is going to decrease, minus sign. So if your cash decreases, you are going to credit the account, okay? Let's say, for example, you provide a service and you get paid for your service in cash. Okay, so what did you receive? Well, you received cash. Did your cash increase or decrease? Well, my cash increased. It's a positive. So that means I would have to debit my account. Okay, so it basically tells you, the first question you have to ask yourself, this transaction, is it an increase or a decrease? Plus or minus? So you need to identify that. Well, it's an increase. If it's an increase, then you would debit. If it's a decrease, you would credit. And this is for assets. Same thing for liabilities. Now for liabilities, the normal balance is a credit. Okay? So did your liabilities increase? Let's say you purchased something on account. Now you owe more money. If your liabilities increased, you would credit. If your liabilities decrease, which is when you make a payment, then that liability account decreases, you would need to debit the account. Okay? So you've got common stock. The normal balance of common stock is a credit. Okay? The normal balance for retained earnings is a credit. So basically for your two stockholder equity accounts, common stock and retained earnings, the normal balances for both are credits. Okay? And then under retained earnings, you have your dividends. Okay? The normal balance of dividends is a debit. Okay? So if you have an increase in dividends, you're going to debit. If you have a decrease in dividends, you're going to credit. Okay? Your income statement account, you've got two income statement accounts. You've got your revenues and you've got your expenses. The normal balance of a revenue account is a credit. The normal balance of an expense account is a debit. Okay? So every time you have an expense, you would need to debit your expense account. Okay? Every time you generate revenue because you provided a service, you would have to credit your revenue account. Okay? At the beginning, it is going to be confusing. You have to really look at this and ask yourself, what is going on in this transaction? Okay? And I'm going to go over a couple of transactions with you, not all of them, but just we're going to run through it and analyze each of these transactions using the normal balance of the accounts, the different accounting equations. Okay? This is something that I do need you to have right next to you as you are journalizing your entries. Okay? It's your map. Okay, that way you understand why is she debiting? Why is she crediting? This is going to tell you that. Okay, and then with time, as you use it, you will learn it by heart. Okay, this is something that you do need to know. It is going to make the rest of the semester much easier if you learn the rules of debits and credits and the normal balances of each account. Okay, now let's jump into the problem that we're going to work on. Okay, these are just basically analyzing transactions and recording them in a journal entry. Okay, I'm not going to go through all of these transactions. I'm going to pick and choose a couple just to provide you as an example of what is it that you need to do. Okay, and then you do the rest. So it says Birdie Consulting Company has the following accounts in its ledger: cash, accounts receivable, supplies, office equipment, accounts payable, common stock, retained earnings, dividends, fees earned, rent expense, advertising expense, utilities expense, and miscellaneous expense. Okay? They're asking us to journalize the following selected transactions for January in a 2-column journal. Okay? Journal entry explanations may be omitted. Okay? So they're asking us to omit the descriptions. Usually when we record a transaction, we always have the debit, the credit, and a description. In this particular instance, the instruction says do not include an explanation. Okay, so that's fine. Okay, so we have the transactions. So what are we going to do? Well, first what you need to do is understand what is going on in that transaction. Okay, so let's look at the January 1st entry. Let's start there. Okay, so it says that you paid the rent for the month, $3,000. Okay, so you're going to ask yourself, well, what is happening here? Well, we are paying the rent for a building and we have to pay $3,000. Okay, so what I would do is I would go back to my little exhibit 3 of rules of debits and credits, and I would ask myself, okay, which accounts are being affected by me paying the rent for $3,000? Okay, so I don't know about you, but when I pay my rent, I have to write a check, and pay my rent. So the money in my bank decreases. Why? Because I'm making a payment for my rent. Okay, so does that mean you're going to have more cash or less cash? Okay, so we are going to have less cash because we are paying something. We are paying the rent. So the first thing you have to identify is, okay, if I have to pay my rent, I'm going to have to use cash. What kind of an account is cash? Okay, so you need to know what kind of an account is cash. Cash is an asset. Okay, so we're going to look at this category right here, assets. Okay, so let's focus on our asset. Let me see, no fill. Let me do red. Okay, so let's look at our asset section. So assets have a normal balance of a debit. That is if your cash increases. Cash is not increasing in this transaction because we are paying cash. So what's happening to my cash? My cash is decreasing. So that means that I have to credit my cash account. I'm going to have to credit my cash account. Okay? Now, we already identified that cash is decreasing. Therefore, I need to credit it. Now, what am I doing with this cash? I am paying my rent. Okay? So, to a business, when we're paying rent, that becomes an expense. Okay, right here, an expense. The normal balance of an expense account is a debit. Okay, so is my expense increasing or decreasing? Are you paying your rent or are they giving you money for the rent? No, we are paying the rent. The expense for the company is increasing because every month we have to pay the rent. Okay, that's costing us money. Okay, so usually every time you see the word expense, it should be a debit to that account. Okay, so your expenses are increasing. Okay, therefore we are going to debit the expense account. Okay, so we've already identified that the expense account for rent is going to increase and cash is going to get credited. Okay, so these are my two types of accounts being affected: assets and expense accounts. Okay, so let's go back over here. Okay, this is happening on January the 1st. Okay, so when we are recording, debits always go first. Okay, always. So what did we say we were going to debit? It says that we're going to debit my expense account. Okay, so we are going to pay, and these are the accounts that we're using up here. You do not make them up. Okay, you have to use the information provided. So if you notice here, we have an account called rent expense. Okay, we're going to use rent expense, and that's what we're going to debit. Rent expense is going to be debited for $3,000. Okay, how am I paying for my rent? With cash. Okay, the debit is always towards the very left side, and then the credit will be indented a little bit. Okay, cash is being credited for $3,000. Okay, debits need to equal credits at all time. Okay, debits always go first, credits go next, being indented. Okay. In the real world, you always have to have a description. Here it says that explanations may be omitted. I'm just going to put this for reference. What are we doing here? What are we doing here? Okay, paid rent for the month. Okay, that way we know what happened here. When you look at the transaction for cash, a credit of $3,000. Well, why do I have a credit on my account? Well, we paid the rent. Oh, okay, that makes sense. Okay, so that is how you analyze each of the transactions. Okay, I'm going to go over like maybe 4 or 5 and that's it. I'm going to let you all do the rest, analyze the different information provided in the book, and you handle the rest. Okay, I'm just going to pick and choose a couple. Okay, let's go to the 6. That's a little bit complicated. Okay, it says here you purchased office equipment on account, $13,900. So what does that mean? That means that you went out there and you bought office equipment. Okay, you didn't have the money to pay for it, so you paid for it on account, which means you owe that money to someone. Okay, so let's say you went to Best Buy and you decided to buy this equipment from them on account. They gave you the equipment, but now you're going to be responsible to pay them back those $13,900. So let's go over here and let's see what happens. So what did you buy? You bought equipment. Okay, so what is equipment? Equipment is an asset. Okay, that is your equipment now because you purchased it. Okay, so you have purchased an asset. Okay, asset is anything that you purchase or that you own. So you did buy some equipment. Now the question is, how did you pay for that equipment? Okay, you bought that equipment on account, which means you owe the money. Okay, so the two accounts being affected are assets and liabilities. You bought equipment, which is an asset, on account, which is an accounts payable, it's a liability, you owe that money. So do you have more or less equipment? Okay, you bought equipment, so that means you have more equipment. So if you have more, you're going to look at the positive sign here, the plus sign. That means I'm going to debit my asset account, which is the office equipment. How did you pay for this equipment? On account. So, do you owe more money or less money? Well, you owe more money, so you're going to look at the positive side. So, if you owe more money, that means you have to credit your liability account. So, you see, you just have to map it. What happened? Your assets increased. In this case, both of them are increases. Assets increased. You now have more equipment, but your liabilities increased as well. And to record an increase in liabilities, you credit the account. So it'll be a debit to the asset, a credit to the liabilities. Okay. So let me go and journalize that transaction. This one's happened on January the 6th. Remember, I'm not doing all of them. I'm doing just some of them. Okay. So the first thing is, which account is going to be debited? We said that the account that was going to be debited was your asset account. Okay. So we're going to look at our chart here, and we're going to say, well, what did we buy? The problem says that we bought office equipment. So we have an account right here called office equipment. That's the account that we are going to use in this transaction, office equipment, okay? How much did we purchase the equipment for? For $13,900, okay? How did you pay for the office equipment? On account, okay? When you buy something on account, it's a payable, okay? I owe money, okay? So we have an account here called accounts payable. That is the account. That's a liability account. We owe money, okay? So if our accounts payable increased, let's look at what would happen. My accounts payable increased. That means I would need to credit my liability account. Therefore, my accounts payable would be credited. So, just to be clear, both of the accounts increased. Assets increased, liabilities increased. Assets increased with a debit, liabilities increased with a credit. Okay? And our accounting equation is in balance. We have one debit and one credit. We're in balance. Okay? Just remember that for every transaction, your accounting equation needs to be in balance. Debits must equal credits. Okay? Okay. So what happened here? We purchased office equipment on account. Okay? So that happened on the 6th. Okay. Now let's look at the 12th. You receive cash from customers on account. $14,770. Okay? You receive cash from customers on account. Okay? So, what does that mean? Okay? That means that some of your customers owed us money. Okay? We are the company. We had provided, we had maybe sold something. The customers owed us money. So whenever we set up or we sell something on account, we set up a receivable, which is accounts receivable. Accounts receivable keeps track of the money that other people owe us. Okay? Okay? And then accounts receivable is an asset account. Okay? So we keep track of the asset account. Whenever anybody owes us money, we set up an accounts receivable and we increase the balance. Okay? And then when they make a payment, they pay us the money back, we credit the account. Okay? So let's look at this transaction. We receive cash from customers on account. $14,770. Okay? So first question is, we received cash. So if we receive cash, do we have more or less cash? Well, we have more cash because we received it. So that means cash would get debited. Okay? Oh, sorry about that. So my first transaction affects my asset account. My second transaction also affects my asset account. So this particular transaction affects two of my asset accounts. One of them is going to increase, the other one is going to decrease. So cash is an asset that's going to be increasing. Now it says, the transaction says that we receive cash from customers on account. Okay, so When customers owe us money, we have accounts receivable. Okay, so if whenever we set up a receivable, that means that someone purchased something from us on account and they're going to pay us at a later time. Okay, so when we set up our accounts receivable, is because someone owes us money. Okay, so if we debit accounts receivable, let me just put a little note here. It means someone purchased from us on account. Okay, when we credit accounts receivable, it means the creditor, okay, it means that a payment is being received. Okay, so accounts receivable, two things happen. People buy from us on account. So we debit accounts receivable. That means that we are recognizing that someone owes us money. Someone purchased from us on account and we need to record that transaction. So accounts receivable is going to get debited. That will keep track of all of the money that is owed. When those people or those companies pay us the money back, they say, okay, I owed you $1,000 and here it is. Here's your $1,000. I'm paying you back 30 days later. Whenever they make a payment to us, we credit accounts receivable when a payment is received. Okay? So the debit establishes the accounts receivable. The credit recognizes the payment that is being made. Okay? Basically, that's it. Okay? So, in this particular case, and remember, accounts receivable is an asset account. Okay? So accounts receivable is an asset account. We debit the account when our accounts receivable increases. Okay? We credit the account when our accounts receivable decreases. So anytime that we receive a payment, we credit the account. Anytime that we record someone that purchased from us on account, we debit the account. Okay? So let's go back and let's journalize this transaction. This is happening on the 12th. So we received cash from customers. What did we get? Cash. Okay, so if we receive cash and we have more cash, we're going to debit cash. Okay, so let's look at what happened. My cash increased. It's a plus sign. So that means I have to debit my cash account. So cash will be debited for $14,770. Okay, and then it says you receive cash from customers on account. People owed us money and they paid us back $14,770. So these people had an accounts receivable set up and now they're making a payment. So when we receive a payment for something that is owed, we credit the account. My accounts receivable balance will decrease. Okay? So whenever we set up our accounts receivable, it's a plus sign. When we receive a payment, it's a decrease. Okay, so I'm going to go ahead and I'm going to credit my accounts receivable because my balance in my receivables decreased. Now people owe me less money. Okay, so accounts receivable is going to decrease by $14,770. Okay, and then here we can just put received cash from customers on account. Okay, let's see which one else are we gonna do. Okay, let's do the 31st. Okay, so it says fees earned and billed to customers for the month $37,300. Okay, so we performed a service. Okay, we billed the customers, but we have not gotten paid. Okay, so people owe us money. Okay, we provided the service, we've generated the invoices, we've billed the customers, but they still have not paid us as of January the 31st. So they owe us $37,300. Okay, so we have to record that we've provided this service. Okay, the service has been completed. We've earned our fees and we've billed our customers. So we've done everything on our end. The services have been provided. We billed our customers. Now we just need to wait for them to pay us. Okay, so we have to record the services performed during the period. Okay, we only record revenues for services actually performed. They have to have been earned. Okay, so fees earned and billed to customers, 37,300. If we perform a service, okay, we generate revenue. Okay, we have to record our revenue that we have generated during the month. Okay, so the normal balance for a revenue account is a credit to your revenue account. Okay, so every time that you generate revenue, you have to credit your revenue account. Okay, now the question happens as to, have you gotten paid? Okay, if you got paid, then that's awesome. Your offset would be cash. You got paid cash. In this case, we have not gotten paid. Okay, we have billed the customer, but they have not paid us. So if we provided a service, but the customer has not paid us, we have to set up a receivable, which is an asset account. So we debit accounts receivable. It means someone purchased from us on account, or we provided a service on account. Okay, so we must debit accounts receivable. It basically means someone purchased from us on account, or we provided a service on account. Okay, so we in this particular case provided a service, and we are still pending for them to pay us. So we need to recognize that ABC Company owes us money. Okay, ABC Company was provided a service. We billed ABC Company, but they have not paid us yet. So I have to set up a receivable. We have to set up a receivable to make sure that we do not forget that these people owe us money. Okay, so it's very important that we do that. Okay, so let's analyze this transaction. Fees earned and billed to customers for the month, 37,300. Okay, so what happened? We generated services. Okay, we generated revenues of $37,300. Okay, so these are the two types of accounts being affected. Okay, so we need to set up a receivable, and remember, if someone purchased something on account from us, or we provided a service on account, I need to debit my accounts receivable. Okay, so accounts receivable, sorry about that, accounts receivable would have to be debited, and that is for 37,300. Okay, did we get paid? No, that's why we're setting up a receivable. Okay, that is the question. Did we get paid? No, we did not. So if you did not get paid for your services, you will always set up a receivable. Okay, now what did you do to set up this receivable? You provided a service. Okay, remember, we're looking at these accounts up here. Okay, we can only use these accounts provided. Okay, we can only use our accounts receivable. It's right there. Okay, you cannot make up the accounts. They have to be from the list. So accounts receivable will be debited. And then what did we do? Well, we performed a service. Okay, and our account for service, or for our revenue, is our fees earned. Okay, so fees earned is our revenue account. Fees earned is our revenue account. So we generated revenue. Our revenue increased. That means I have to credit my revenue account right here. So what happened to your revenues? They increased. It's a plus sign. And that means we have to credit our revenue account. So we're going to go ahead and have fees earned of 37,300. Okay. Fees earned and billed to customers. Okay. So these customers, remember, services were provided. We've done everything on our end. Now they owe us money, so we have to set up a receivable. That way we remember. Now accounts receivables, we should keep very close eye on them. We will cover accounts receivable later on in the semester. But accounts receivable is something that you have in your books. And the longer you wait to collect, the more likely it is that you're not going to collect that money. So you have to monitor your accounts receivable account very closely. Okay, and make sure that you look at the terms. Okay, usually we give our customers up to 30 days for us to pay. Okay, if the customers are not paying us within the established time frame, we either need to stop allowing us for us to provide services and account. We need to make sure that we collect timely. Accounts receivable is a major component of many of the businesses because, as you know, most businesses provide services on account. Okay, but they have to be with customers that actually pay them back. If you have a customer that never pays you, you need to stop offering your services on account to them until they bring their accounts up to date. Okay. Okay. And the last transaction that I'm going to go over is with you today is your paid dividends of $800. Okay. So the word paid means that you paid. And how do you pay? With cash. Okay. So we're going to transfer this. In this particular case, we have two accounts being affected: dividends and cash. So you made a dividend payment. So you paid your stockholders a dividend amount. Okay. So what's happening to your cash? Is it going up or down? If you're paying something, cash will decrease. Okay. So cash is going to decrease. That means you would credit your cash account. Okay. Now we're making a dividend payment. Okay. We have to keep track of all of the dividend payments made every year. Okay. So dividends, the normal balance of a dividend is a debit. Okay. So what happened? We are paying dividends, so we have to keep track of all of our dividend payments. Our dividends are increasing. Okay. So we are increasing our dividends. That means we would have to debit our dividends for the amount, and then we would have to credit our cash for the dividend payment. Okay. So we are dispersing money to our stockholders by making a dividend payment. Dividends increase, cash decreases. Okay. So what happens here? Dividends get debited of $800. How do we pay for our dividends? With cash, $800. Okay. And that is what we have. Okay. So basically, for every transaction, you have to figure out, first of all, the account that is being affected. You have to look for the account in the actual chart of accounts. Okay, the problem should provide you with the list of the accounts. You can only use the accounts provided. Okay, and then you have to figure out, okay, are these accounts being debited or credited? And what type of accounts are they? First of all, what type of an account? Is it an asset, a liability, common stock, retained earnings, dividends, revenue, or expense accounts? Figure out which accounts are being affected. And then after you figure out which accounts are being affected, you have to figure out, are they increasing or decreasing? And then you figure out if they're increasing or decreasing. And then that will tell you if you need to debit or credit the account. And every account has a different balance. Okay, some of them debits increase, others credit increases. Okay, so that's why I ask, this is confusing, keep it handy at all time. That way you can figure out what's happening. Okay, and that way you know if you need to either debit or credit an account. Okay, so this is going to be the map for you to understand if an account needs to debit or be debited or credited. Okay, so these are all of the transactions that you need to analyze. I've gone through 5 of them. You will do the rest. This is just for me to kind of like show you how is it that you needs to get done. And then after you do them, what I like to do is I like to make sure that my debits equal my credits. If my debits do not equal my credits, then I've got a problem. Okay, so in this case, debits and credits equal. That gives me some peace of mind that my equation remains in balance. Debits must always equal credits. Okay, so that is basically it. That's what I'm going to be covering for this. Please analyze each transaction carefully. Make sure that you understand what is happening, identify the accounts being affected, and whether it's going to be an increase or a decrease, which translates to either a debit or a credit, depending on the type of account that we are looking at. Okay? If you have any questions or concerns as you're working your homework, please make sure that you send me an email message, a Blackboard message. Just include the problem number that you're dealing with and your specific question or questions and your attempted solution. Okay? That way I can provide guidance. I'm not going to give you the answer, but I will provide guidance. Please refer to your textbook. There are so many examples being included, and they're being explained as to what is being debited, what is being credited. So make sure that you take the time to read. Okay, so that is it for this lecture. Until next time, have a wonderful day.